you're like managing $3 billion and founder walks in and you're assessing this in 1 hour. What happens in Café Venetia that you say, oh, this?
If you're not going to adapt, you're going to die. If your moat is your code, good luck, okay? It's far worse to miss something than to make a bad investment. Because if you make a bad investment, you lose 1x your money. If you don't invest in something that could have been 100x, you missed an opportunity to make 100x.
Oren, why did you take the solo venture capital path?
Because I've had experience working with people.
Welcome back to another episode of Invested. I am thrilled to be here with my old friend. I think I can call you that, Oren, right?
Friend, I don't know, but old for sure.
My old friend and colleague, Oren Zeev from Zeev Ventures. Welcome, Oren.
Thank you. Great to be here, Mike.
Oren, how long do we know each other? It's like since the mid-90s, I think, right?
Yeah, it's 30 years, yeah.
And our careers are taking a slightly different but same path, which is we're both still venture capitalists, which we both were all those years ago. But I've continued to live in a partnership, whereas Oren is probably one of the pioneers. There are a few others, Steve Anderson and others, of the solo venture capital model. So much so, Oren is now managing, I believe, almost $3 billion. He doesn't have an office. He takes meetings in Café Venetia in Palo Alto, a place I haven't been to in a number of years. Oren, why did you take the solo venture capital path? You started in partnerships. You were at Apex Partners. What made you take this solo path?
Because I've had experience working with people.
Okay, explain, Oren.
No, look, I think and admittedly, I was in a very large partnership. I think I'm sure it's not as bad in a smaller partnership, but I think in a large partnership, you have all these forces pulling in different directions, and I think mistakenly think of venture as team sports, and to some extent it could be, but more often than not, it's more of an individual sport. So many of the partnerships, in theory, they're supposed to leverage the individual, but in practice, they handicap the individual because everything takes longer, everything has to be more consensual. And I'll give you the biggest argument, I think. You know that our industry is so asymmetric. There are mistakes of omission and mistakes of commission. It's far worse to miss something than to make a bad investment. Because if you make a bad investment, you lose 1x your money. If you don't invest in something that could have been 100x or 200x, you missed an opportunity to make 100x. And, parallel and all that really affects the top one or two investments in a fund. This is really what dictates the performance of the fund. So even if you had really good, smart partners, which is not a given, by the way. Maybe you were more spoiled than I was in this regard. And even if they're not political, and even if everyone really wants everyone else to be successful, which again is not a given, your partners will never make you make an investment that otherwise you would not have done yourself. But the opposite is not true. They may prevent you from making an investment because they would ask you a question, push back, slow you down, etc. So even if you have these smart partners, and even if 5 times they're really preventing you from making a mistake, and thanks to them, you did not invest in something that otherwise you would have lost, it's enough that one time they prevented you either by explicitly preventing you or just by slowing you down and causing you to lose the deal, something that was truly great, the whole thing wasn't worth it.
So all feedback, therefore, is negative in the investment process.
For the most part, it's have you looked at this risk? Have you checked this? Have you done that? I find it difficult to believe that the partnership or the partner is not sure he wants to do something, and the other partners are pushing, no, forget this, you should go do it. It just the dynamics is usually more of a conservative. Have you thought of all these risks as opposed to the other way around?
Sometimes I find that my partners sharpen my own conviction, even. We're like, I'm on the fence. I'm thinking about it, and they ask questions and try to beat down the deal. And because I'm forced to defend it, it sharpens my conviction. You don't think that exists?
Fair enough. No, this is your partnership. I'm not going to argue with your partnership. My living experience was different. Plus, I do have people that I that I consult with. But I don't have to convince them, is the point. If I have enough conviction, then even if they're skeptical, I'm thinking of specifically someone who's a venture partner, was a who I routinely consult with, but I don't need to convince them. It's a big difference, in my opinion.
When you make a decision, how long does it take you?
Oh, very quickly. It almost always less than 24, 48 hours. And typically there's up to one issue that I feel that I need to check. And it's an easy check, like 2 or 3 phone calls, or looking at
What is that? What's the thing you most often need to check?
just looking at maybe the traction, looking at the numbers, to figure out whether if I, in my subjective view, see it as a real signal or just noise. It's typically not the individual founders, because typically I already know them, or they come already very vetted to begin with. It could be one nagging question that I have. How would, for example, in the case of Navan, when I made the investment, my big question was: is there really an opportunity in corporate travel? How open would companies be to replace what they're using? Because it wasn't a new category; there were already very large players. And so I basically called 3 or 4 CFOs that I knew and asked them, would they be, what are they using? Do they like it? And would they be willing to replace? And regardless of what the answer was to the first question, the second question was, I hate it. Whatever they were using. And then, yeah, if something was better, I would be open. So that was my question in that, when I did Riverside, I mean, we're using the platform right now. Again, my question, maybe it was a dumb question, but that was my question at the time, was why wouldn't be just be a feature of Zoom? Because Zoom was all the rage back then. And I made a few phone calls and convinced myself that they're not necessarily focused on it. And you know how it is when a company, maybe they could do something, but if they're not focused on it, they're never going to do it well. So there's an opportunity for startup.
I asked David Marcus what to ask you, and interestingly, he has the same observation about you that I have, which is that you have a very high IQ, of course, but you actually have a super high EQ for people and very little ego, which I've always found endearing about you. And David Marcus does too. And so, like, you walk in and you're sitting at Café Venetia, you're like managing $3 billion, and founder walks in and you're assessing this in 1 hour, because that's what it is. And by the way, we're going to come back to Navan in a second. What happens in Café Venetia that you say, oh, this?
So first of all, it's without an N at the end. It's Café Venetia. There's no N.
Venetia, sorry.
I'm not sure my wife would agree with the definition of high EQ and all that, but I'm gonna use it as evidence. But I'm not sure she would agree, and she's actually qualified because she's a psychotherapist. Look, I need to feel a few things. I need to feel that I have a real competitive unfair competitive advantage versus other VCs. So it's not like a deal that everyone can necessarily do, but for whatever reason, the founders prefer me, and it's basically always based on. It's never based on domain expertise, because I'm never gonna be the best domain expert in anything. It's based on personal relationships. Someone I've known, maybe even backed them before, or a very, very, very strong, multiple strong first degree of separation. So that's one thing. The second thing is, I need to feel that there's a real opportunity to build a viable company. If we end up selling along the way, okay, but I'm not comfortable playing a game that I know this is just. So I really need to feel that this company has a chance to invent a new category, reinvent the category, and become a market leader. I think the difference between a market leader and number 2, 3, 4 is vast. And then I need to like both the founders and the idea, and at least one of them has to be somewhat proven. Meaning, either the founders are somewhat, for example, second timers. That's easy. or close to it, or there are some very early signs. It could be very early. It could be a very faint signal, but I have to believe that it's a real signal of indicative of product market fit. So, for example, in the case of Riverside, it was two very young brothers. They were at the time, I think, 24 and 20, and the third brother joined later. So at the time, it was just 24 and 20-year-old brothers. Obviously, first timers, so it still wasn't that, but they had a very basic product. They didn't even incorporate a company, but they had a very basic product, and it was even buggy. And it wasn't perfect, but they were getting 5, 6 new customers, paying $40 at the time, paying $40 per month every day, and the pace was going up without doing any marketing and sales. So I think they had maybe $5,000 of MRR. So it wasn't like big numbers. They had maybe 100 or so subscribers. But what I was telling myself is, you don't get 5 or 6 people to find you and pay $40 every day and going up, unless you hit, without any investment in anything, just word of mouth, unless you hit some real need that's not being addressed by other players. So that was my thinking. So that was an example to something that was still very, very early. By the way, it doesn't even have to be revenues. In the case of Houzz, there were no revenues.
I need to ask you 2 quick questions on that. Do you ever invite the founders to your house or only Café Venetia?
Mostly, I don't invite them to my house, but just out of respect of the personal space of my family members. But every now and then I do. So
And in Riverside, were you not worried that this is like a family business? Like our own experience with brothers and multiple family members starting businesses is most often, not always, doesn't end particularly well.
I would say that most startups don't end particularly well. So the question is, do you ascribe it necessarily to the fact that they were, because I think sometimes we draw the wrong conclusions, right? We invest in them, in a husband and wife. They fight, they get a divorce, the company fails, and we say, "Oh, I'm never gonna do that again." But we could have invested in two people who were not married, and they would fight, and they would still fight, and the company would still fail. So the answer is no. I'm not bothered by that. I have them. I had Houzz, who are husband and wife, they're brothers. My good friend. I didn't invest in that company, but my good friend Oren Zeev, he started a company in Ireland with 3 brothers.
Yeah.
And built a big company. This is like in the 90s. The listeners are not gonna know the name anyway, but it was one of the first CRM companies called Scopus. And there are many other examples, but they're not necessarily in my portfolio, as you know, of companies, very famous, successful companies that became. So no, I don't. I don't not do a deal because of that. And I think it's dangerous to draw their own conclusion because it's based on one data point typically. Oh, I heard I once talked to a VC, I'm not going to name them, who told me that they're never going to invest in a company from Santa Barbara. Why? Because they had a company in Santa Barbara and then they were surfing all day and they didn't succeed. Okay, but you're actually extrapolating from an end of one. Come on.
Yeah. And you surf, so that's not even a bug in your mind.
Yeah, but yeah, I just do. But actually, I when he told me about this story, it was before I was surfing, so it's not even.
I'm interested about something you said about success. So we have a joint investment in Spines, the AI book publishing company. You said before you want a founder who's had success, at least one of them. Do you regard Yehuda Neev, the founder of Spines, as having had success before?
In the case of Spines, it was very clear that he already had traction when I invested. You invested before me, so I give you credit for that. You did the seed, and I came back a year later at DA. When you did it, it was very early. When I did it, he already had something like $5 million of revenue run rate. So I actually saw. So this actually falls in the bucket, not in the bucket of second timer. But on top of it, Yuda had relative domain expertise because it started but in non-tech, no. But in this particular case, it was definitely the bucket of traction from the company, not because of Yuda's success in the because his success was not in a tech business, and it's different. So I didn't So it was really based on the traction and the rapid growth, which, as you know, continued since then.
Yeah. I want to make an observation, by the way, about spines and about Oren Zeev for a second, which I'm sure somebody else has made before me. So, for those who don't know, you were the big investor in Audible, which now
Yeah,
everybody uses for audiobooks before anybody really knew what an audiobook was.
yeah,
And you were one of the original investors in Chegg, the textbook company,
yeah,
and now in Spines, an AI publishing company.
yeah.
What is it with you and books and publishing?
I think the honest answer is that it's a coincidence, but it's a nice coincidence, and I may be, especially if and when Spines is a big success, I may be the only VC in the world who who hit gold 3 times in the book. I actually, I don't even know if there's one who did it twice. So maybe I'm already there. You don't think of books as a venture investment, right? And somehow I managed to be the main backer. I was 40% of the company before it went public for the second time in 2004, and became a huge business. And Chegg became a huge business for a while, and then got decimated, obliterated by AI. But that post dates, and that's years after I already was out of the company. So it was also a home run for me. And now Spines, but each of them brought a real innovation to the and created really a new business. And each of them was the first two for sure. The third is still a work in progress, a market leader. And books is a big category, so it turns out that even in a category like books, you can innovate. First with audiobooks, then with textbook rentals, and which developed into homework help, which and Spines, of course, is the one who's doing the self-publishing using AI instead of manual.
So you made the observation earlier that you want to make sure that the company can be big, and if it gets bought on the way, so it gets bought on the way. You also just made the observation, which is obviously correct, that Chegg got obliterated by AI, and it's obviously after you, the venture capitalists, are out. How are you thinking about moats right now in all of your investments? Like, what is immune from the AI juggernaut that's currently kind of overwhelming the world? It's like a tsunami. If you look at Chegg's stock price, and I hope they'll put it up in the background of the podcast here, it's like a cliff. Um,
Yeah. No, you want so I believe the enterprise value is probably zero. I think they're probably worth so negative. I think they're probably worth less than the cash.
well,
Um, yeah. So it really got this like obliterated. Chegg, I don't know if they could have done anything, because Chegg, the whole business was homework help, and they had I don't know 1,000 or more. I don't know how many because I was no longer with the company uh, uh, when these things happened. But they had subject matters, PhDs in India, helping people. So that's just the essence of ChatGPT or Claude. This is just I don't know that they had any chance, but I think many times companies do have a chance to adapt quickly, and because if you're not going to adapt, you're going to die. Okay, whatever you think your moats are, if you're not adapting, you're going to die. But I think more often than not, companies do have real assets, and that are not just immune. Some of them are even worth more thanks to AI. So if your moat is your code, good luck. Okay, because it's no longer a moat. Okay, if it used to be. But there are multiple things. For example, if you have proprietary data, is not only a moat, it's even a more important moat in the age of AI than it was before. Um, Connectivity integration with all sorts of archaic data source, not things that are open or APIs or things like that. But for example, in the case of Navan, think of all the connections to all these archaic systems with the airlines and the trains and the this and that. That's not necessarily available. Then you have a regulatory environment and licenses. For example, in the case of Tipalti, just the licenses took us 4 years, and millions of dollars.
tell our listeners what Tipalti is, because they don't know.
Tipalti is then today the market leader in finance operations automation in the mid market. And their core, they grew from accounts payable, but they're expanding to other finance automation. And it's a multi-$100 million revenue company, also still private, but also a big winner that I helped start. So I can go, so that's another set of especially in fintech, you have these barriers. You have trust, brand and trust of customers for things that are critical, for things that there's no tolerance for hallucination or mistakes, or the probabilistic outcome, that it needs to be deterministic. So you have a host of different modes. So some of the modes that used to work don't work anymore, and some maybe that were less important, like proprietary data, can be much more important. But overall, I think many companies, not all, but many companies have real assets vis-a-vis both a new entrant that is, and also a big lab, because the big lab is not going to do everything. I think that's also a fantasy to think, oh, Anthropic is going to do everything, or OpenAI is going to do everything. That's not going to happen. Just like Microsoft didn't do everything in the 90s. So the missing ingredient, though, is the adaptability. How quickly a company really dramatically adapts, looking at every function and every product feature, and asking themselves, if we're doing it now in the age of AI, how would we have done it, and then just do it. This, I'm talking about everything. The structure. Who. The org structure, the product, the operations, the development, everything. You have to rethink and move very quickly. And in this regard, I think that companies that are founder-led and are at 50 people, 100 people, 500 people, 1,000 people have a huge advantage versus dinosaurs who are 30,000 employees, 50,000 employees, and are professionally, air quotes, led. And so I'm actually really, really, really bullish about venture in general. Obviously, the last 3 years since AI, obviously AI is good for venture. Let's start with that for two reasons. One, any change is good for venture, because if everything is stagnant, startups cannot be successful. The incumbents win. But the real advantage that startups have is when things change. So number one, it's a huge change, the biggest since the beginning of humanity, I believe, certainly for technology. And the other thing is, it's a change that dramatically increases the pie, enlarges the pie, because things that before that could not have been done with technology are now being done with technology. So technology captures a bigger, and spines is an example, but not just technology is capturing a bigger share. Before that, maybe a software company, maybe they were selling a license for $100 per month. Now they can sell an agent who would replace the person who was using this seat, and instead of $100 per month, maybe they can charge $10,000 a month, because, or $20,000, not per month, per year, because that employee was costing the company maybe $100,000. So both enlarging the pie and huge change, great news. But my point is that not only is it great news for these vintages, I actually believe that a lot of the pre-AI era company, the ones that have very, very strong founders, leadership, are actually gonna be also big beneficiaries, because they bring some real advantages to the game on top of the AI.
Yeah, it didn't work for Chegg, but
No, it didn't. No, some are gonna get killed. Chegg is not gonna be the only one, of course. In fairness to Chegg, I don't know if there's anything they could have done. When your entire thing is just so squarely, has AIs just doing it like that, yeah, they had no moat. I don't see how they could have.
I want to latch on to the old guy comment you made, because I actually make it all the time inside of our partnership, and to anybody else, about Microsoft in the 90s. When we got started in the venture business, every time you sat around one of those large tables that you talked about before, you said, "Oh, Microsoft can do this. Oh, Microsoft can do this." And by the way, when it was in the networking space, sometimes it was, "Oh, Cisco or Lucent's going to do this too." Like that's literally the environment I think I grew up in. You probably grew up in too. And
Yep.
now when I hear, "Oh, it's going to be absorbed in the models," we go, "Here we
Yep.
go again." It's the Microsoft company. It turns out that this is not true. And so, the question I want to ask you is, what is your thinking model, your mental model for what the models will do versus what they won't do?
Mhm. Now you're really, really challenging my IQ, and I don't think I'm smart enough to really answer that. First of all, I do think it's still worth posing the question. Will OpenAI and Anthropic do it? I don't think one should not ask the question. Um, but you cannot assume that they're going to do everything. This is just foolish. I'll give an example from Microsoft. When I did Chegg, last minute I convinced Don to invest a little bit more so I could get even more. And I brought it back to the committee, and it didn't pass. And the reason it didn't pass is because at least one partner had an issue that, what if Microsoft does it now? And I'm going, what is the connection? They're selling books. Why would Microsoft sell books? There's zero connection. Where did you even get this? Where did you pull this out of? But he was obsessed with that, and so he didn't want to risk more money on this. But just an anecdote. So I think you should ask the question, and of course they will do some things, and there will be some fields where they are not gonna maybe leave an opportunity, but for the most part, it's not gonna happen. They're not gonna become a travel company now, or a couch band, or fintech company now, or bank, or um so I think one has to look at it specifically. I don't know. I don't have a general answer, but I think on a case by case basis, one needs to look at it and think.
Yeah, I want to spend a few minutes talking about Navan. And I want you to really take me from the beginning of Navan, the first meeting with the guys, which was called TripActions, if my memory serves me correctly,
Yeah.
to begin with, and really walk us through because there's so many stories there, right? COVID hit, it reduced the business to close to zero. This has been a up and down play. Then the company goes public and the stock tanks, and you go on record on CNBC as saying, "Okay, Mr. Market is in action, but wait for the long term. Eventually, the stock price will catch up to the business results," and it's come back a
Yeah.
bit since then. This has been just an incredible story, I think, from beginning to end. So I want you to walk us through first meeting, ups and downs along the way.
First, I'd known them um before. And
How?
I even had a small angel investment in the previous company, which was called Stream once. And then one day I walk on university, and they sold it to Jive, and the Jive office was on Lytton, which is 1 block away from University Avenue. So really 1 block away from Venetia. So I walk one day, and I see them on the street, and I say, and hey, you guys, well, you want to have lunch because I just had the window, and they sure, why not? We're having lunch, and they don't even tell me anything. Last 5 minutes, they tell me, oh, by the way, we're thinking our we have there was still Jive. They were still during the time that they need to vest. We're thinking about something new. Immediately, I said, okay, we got to meet tomorrow for coffee. Or maybe it was the same day that we just after lunch continued to the coffee, and then they pitched the idea that nothing. It's just oh, we're gonna do this. But I got excited. So, okay, let's meet. Let's meet tomorrow and talk about it again. The next day, Elon comes with a mock-up of some screenshots that he did overnight, and I think in that meeting we just agreed that I'm gonna fund it and back it, um, and we're good on terms, and we raised a toast of what do you call the Italian equivalent of champagne, prosecco. We raise the toast, which I never do. I never drink alcohol, but we raise the toast of the success of the venture. I don't even remember if yeah, I think the name existed already, but and by the way, between the 24 hours, this is what I did. I called a few CFOs and asked them about this specific question: will people switch? So that was how I invested. They tell me that of course they would have come to me anyway, So I don't know if it was, I don't know if but anyway, I literally, I saw them on the street, so it was serendipity, although they tell me that they would have come to me, and they could have come to me anyway. So we would never know. So in the beginning, we had a few years where everything was working great, and it grew very fast, and first of all, we lucked out that I hadn't realized that it's not easy to get the content meaning the flights and the hotels and all that. But they lucked out and they managed to get it. They grew fast. Everything was going great. I think the first existential crisis happened even before COVID. There are three large airlines in the US. There are other airlines, but there are three large ones that you cannot do without. American, United, and Delta. Delta being maybe the best run company of the three. And Delta in 2019 decided that they hated Navan, like with a passion, and wouldn't even tell in that we cannot use Delta, which is a death sentence, because we cannot go to a customer, and say, use us to book your flights, and by the way, you cannot use Delta. It's not Frontier or Spirit RIP. That was an existential crisis. And long story short, somehow, actually, thanks to Ben Horowitz, who became involved at that point, that's exactly when the same time that Andreessen invested for the first time, and actually Ben helped us figure it out with Delta. We solved this problem. This was a real existential threat that I thought we know we could have lost the company of this. Then COVID hits, and COVID hits. I've never seen anything like it, because you have a company at that point. It was beginning of 2020. We are at about $80-90 million revenue run rate, or ARR, call it, because it's usage, but it's recurring. And it goes over 1 month, it goes to zero. April 2020, it goes to zero. I remember when COVID just started, someone wrote an email, even if revenues go down by 50%, and someone else says, they can go down by more than 50%, went down to zero. Okay. Obviously, because nobody was flying. And by the way, consumer flying came back way faster than business travel. Business travel did not come back for a long time, but the main thing is that we had no idea when it will come back. Now, cash was less of an issue. First of all, we'd raised before, but miraculously, Ariel was able in April or May to secure a big investment from Green Oaks, which was structured because you could not price the company, so it was structured, but it was money. It was real equity and real money. So the issue was not running out of cash as much as it was running out of talent. The reason I say this is because back then, the first 2 months, no problem, because everyone froze. But come June, you're starting to see companies like Datadog and Zoom and Databricks and Snowflake just crushing it, during COVID. And they're all going after our people. And I'm not worried about the travel people, because they had nowhere to go. But the engineers and the go-to-market people, their skills are transferable to any of these companies. And at some point, I think Ariel was the only employee in the company that didn't get an offer from one of these companies. And here I have to give the greatest credit to Ariel for his leadership, because that's when leadership is really being tested. And the fact that he was able to inspire enough confidence and enthusiasm that despite everything, we're gonna prevail and we're gonna do great. And we manage to keep almost all executive team, and maybe we lost 20% of people that we didn't want to lose, but we managed to keep the core. That to me is a huge. This is the ultimate leadership test, I think, and he passed it in flying colors. Now, on top of that, I would say everything had to be relooked at. So first of all, we were the very first company to let people go, because all the customer support people had nothing to do. We let them go like within days. And we did it over Zoom because there was no other way to let go of people. Of course, we got a lot of grief from the press, especially the Israeli press. How dare we fire people over Zoom as if there's any other way to do it? At that point, but again, to Ariel's credit, he was never too bothered by that. He was never too obsessed with whatever the media was buying, was writing at the time. But it's not just letting go of people. It's looking at the roadmap, shifting resources. For example, we had a nascent expense product. And the expense we could still sell because people still have expenses. So we shifted resources and accelerated the expense product at the expense of the travel. We changed the way we changed the product map. We prioritized features that had to do with, for example, safety. What's the safest route to go from A to B once people started to flying again, etc. Bottom line, we survived it. It wasn't easy, it wasn't pretty, but it took a while. But we survived. I think the day we knew that we would survive it was the day that the vaccine was announced, sometimes in 2021, and we knew from now it's just a question of time. And that's when we managed to get also more financing, and then a year before the IPO, we had some another, maybe not as existential, but we were like 2 months. We had some mistake in the way we were managing things, and we're growing very fast on the expense side, which part of it was giving credit to customers, and the business was going great. And thanks to it's going great, we almost ran out of money. It was very close.
People don't understand this, by the way. It's actually growth that takes capital.
Yeah, exactly.
Yeah.
So we were like 2 months from running out of cash, and it was a breach of covenants of the money warehouses and things like that. Okay, so that's another one. And then we go public, and this is the worst public IPO of 2025 by far. And by the way, Chegg was the worst of IPO of 2013. So twice I've been part of the worst IPO of the year in terms of performance. The company was received like super badly. To this day, I don't fully understand why. Even like the first minutes, it started to slide down. It went down from $25, which we didn't even think 25 was expensive when we took it down public. It went down all the way to something like $8. Michael, at the end of the day, if you know your business is great, why should you even care that the public markets are taking time to see it? If you really have conviction, and the answer is sometimes it's a self-fulfilling prophecy, because sometimes you could have talent flight because people start losing confidence because they see their options are worthless, and or the equity is worthless, etc. And here again, it again comes back to Ariel's leadership, because what the attitude was at the company, and I saw it. The attitude was fuck the public markets. That was the attitude. We are doing great. We're gonna continue to do great, and eventually we're gonna beat and raise and beat and raise and beat and raise, and eventually the public markets are gonna get it. So now it moved in the last 6 weeks. It moved from $8 to 18 plus. Of course, I cannot comment, but I personally, anything specific, but I personally still think it's very cheap. I think this is going to be a massive company, and eventually perception catches up with reality in most cases.
Yeah. And
In most
how
cases.
long are you going to hold your shares for generally? You don't have to be specific about this one.
Yeah, no, generally, as a fund, I don't think it's my role to hold public shares for the LPs. So personally, I do distribution in kind. I pay myself the carry in shares, and then personally, I want to sit for the next 20 years. But that's personally.
Are you holding Chegg still?
No. I got out actually too early. I got too early because I got out. It was still worth about $1 billion. And it went all the way up to 13 billion before down to zero. But But I needed the money. If I didn't need the money, maybe I would have kept it. Specifically in Navan, so from a pure standpoint, I don't think of any company. I don't think that it's my job to hold the shares, and I think I should distribute the shares as soon as possible, but I shouldn't be stupid about it. So if it's so obvious to me that there is a disconnect between the market price and what I think, then I'm going to deviate from the purist approach and wait for another quarter, another 2 quarters, another 3 quarters. But so, and then also distribute it over time. I think you did the same with Lemonade. I know because I was on the receiving end. I was an LP, and I remember that I got the distribution every few months, and it went great. I think it worked great.
We still hold a bunch.
You still hold a bunch. Okay, great. So maybe I'll get some more. So as an LP, so I do think that I want to wait until I feel that the public market understands the company, and then distribute, but over time, to average out, because I don't know how to pick the right time to sell. So I want to sell over time to average out.
I want to ask you a bunch of rapid questions to wrap up here. What percentage of your founders are Israeli?
Probably 80%.
80%. What percentage of those, the headquarters, are in the US of the 80%?
Believe it or not, I can only guess because I never prepare any slides for anyone, so I never do these statistics, so I have no idea. But just as a guess, I would say maybe 2/3 headquartered in the US and a third in Israel.
You think that's important for the Israeli companies to be headquartered in the US?
If the CEO needs to see customers often, then I think it's extremely uncomfortable, inconvenient to be in Israel. But if it's a B2C company, or for example, or a small business, so it depends how much. I think, but it's a personal, individual. I think it's better, but I understand that people have their personal priorities as well.
What's something we can't find out about you on Google?
It's not that I'm good, but I play table tennis almost every day and in a league once a week. So
You've invested 80% in Israeli companies. I think 25 or so years ago, you moved to the US, first to New York and then to Palo Alto. When are you moving back here?
Soon, with all these woke communists in California now. No, honestly, I don't even see it as binary at this point because, obviously our kids are out of the house. Interestingly, both our kids live in Israel, decided to live in Israel. Both of them, despite having grown up in the US, both of them live in Israel. We have a place in Israel, Neve Tzedek, which we love, and we love spending time in Israel. So honestly, I don't see it as necessarily a binary thing. I think we're probably gonna spend time in both houses. We don't have more than 2 houses. I don't see why. We would need more, but yeah, it's not binary. I think we're gonna spend more and more time, especially now because our daughter just moved 3 months ago from the US to Israel, so we're probably gonna spend more.
Last question for you. What's an unpopular opinion you hold that you haven't talked about publicly yet?
There is now this narrative that it's no longer enough to grow 100%, 200%. If not growing 10x, you're not worthy of our money. This is like the narrative of some VCs. And of course, if you're growing 2x and all your competitors are growing 3x, that's not, or 4x or 5x, that's not a good thing. But if you're doing something special and good and unique, and you're growing 2x at scale, I'm not talking growing from 1 million to 2 million. I'm growing, talking from 20 to 40 to 80 to 160, and you have real moats and it's sustainable. Then I don't think the math changes. I think that in 6 years you're going to be 64 times bigger than what you are today. If you are growing 2x in a sustainable way, and I think it's become really bon ton, and I think I know why. I think that you sound very, as a VC, you sound very good when you say, for me, 2x, 3x is not good enough anymore. We don't invest in 10x, you sound that, yeah. So I don't buy that. The math is still the same math. And I would much, and the thing is, it's also very dangerous when you and I have lived through this period, more than once actually, that if you only look at top line growth, nothing is good enough. it also creates very problematic, to say it very mildly, behavior. Because you're going to find that the growth is not real, it's not sustainable, it's not real. Sometimes outright fraud, sometimes it's not fraud, but it's just not sustainable. Um, the insurtech thing, I mean, Lemonade is now doing great, but not just Lemonade specifically. In the space, there were a lot of companies that ended up um, being worthless because they were showing great growth. Because in a business like insurance, you can always show growth if you misprice the policy. You can have nothing other than mispricing the policy and still grow. Show growth. So my point is that it's not just wrong. I think it's a dangerous mindset.
That is a fantastic place to end, by the way, and that is going to definitely be the outtake of the episode because you are so right. And everyone's talking about how do I have a little bit of Anthropic, a little bit of SpaceX, and you need all those other things. But there are a lot of great businesses out there like Navan and Tipalti and Spines and many others. If you've enjoyed this podcast, please join me, first of all, in thanking Oren for coming on the podcast. And you can find out more about him if you follow him on X, and that's Oren Zeev, ORENZEEV, and same on LinkedIn. And Oren, really, thanks for doing this. I appreciate it. And if you enjoyed the podcast, please rate us 5 stars on Apple Podcasts, on Spotify. Subscribe to the YouTube channel for more wisdom from Oren Zeev and some of our other guests. Thanks, Oren.
Thanks so much for having me. I enjoy it. Thank you, Michael.